So let's get started. What were the main takeaways of this class? And remember, today I'm not going to be brutal and go on for 2 hours. There's no assignment. Okay, so just let's focus on the main takeaways. Takeaway 1. Value comes incrementally. And this is not necessarily in the order of importance that I'm talking about. I'm just talking about how you, order of thought process. Value comes incrementally. What do I mean by that? I mean by that you can't just think about the new project in isolation. You have to think about the world with the new project and subtract the future cash flows without the project. Doing it this way will always make you make good decisions. So remember, whenever in the beginning you're evaluating a new idea, always project the world, the cash flows or resources or whatever you want to think, love, pain, in the future, without the project, and then do it with the project. And it's the difference in the cash flows that is value creation. So that's the first point. I hope you think like this and you'll go very far. Value is always relative. Throughout this course, I've emphasized that the cost of capital does not belong to you. You have the ability to generate expected cash flows based on a cool idea. Cool ideas are very tough to create. However, even cool ideas cannot be evaluated unless you know what the value should be, what the discount rate should be, what the hurdle rate should be. And I'd like to talk about the law of one price, which has been the essence of what we're talking about. Like life, it's not perfect, but it's a guiding tool. Everything I'm talking about, the main takeaways, are guiding philosophies. And here's the thing about relative, is that if I wanted to evaluate orange, or if I wanted to evaluate, say, a completely new idea, what's the difference? So think about it. If I evaluate orange and there is an apple, similar firm, sorry for the joke, but whatever, orange versus apple. If there was no apple, it would be very difficult for me to value anything because all values are relative. Law of one price says this, that if you take a comparable that's approximately the same as you, in the case of orange it was apple, the rate of return has to be the same on both. So I can value things in a relative fashion. So let me tell you a little joke here. Famously said about economists that we do not know. We know the prices of many things, but we don't know the value of anything. And the reason is value is relative. So if you asked me what is the price of one bottle of ketchup, I can tell you it's twice the value of half a bottle. But why half a bottle is $2 is a very tough question, right? So why the heck does an iPad cost $1 gazillion versus a phone or a jacket cost so less? You know, those are issues that are too deep. But everything is relative, and therefore I wanted to emphasize that relative valuation is key. Why am I doing this? Because if you do not follow the principle of getting your cost of capital from the next best alternative, you're screwing up the whole framework. And by the way, this is very common. How do people, lot of very intelligent people, how do they value their projects? They just pick up cost of capital from thin air. And usually it's exactly round number, like 10, 15. Can't be true, right? I want to push this a little bit so that you remember that all value is relative, and we hope the law of one price, which says if you walk like a duck, talk like a duck, you probably are a duck, is the thing to remember. Let's move on to the next one. Just focus on these for the time being, and I would encourage you not to take a break, but of course you can do whatever you want. Value comes from the future. What do I mean by that? So, okay, value is incremental, value is always relative, value comes from the future. Why am I emphasizing this here? Because if there's one thing you always want to keep in mind when I ask you about value, is first look to the future. If the future has nothing that's coming from your specific idea or project, the value has to be zero. So let me give you an example which I gave earlier. Google was started several years ago. Huge amounts of investments were made. Before it was started, what decision was made? Hopefully, either through Excel or through back of the envelope calculations, probably the latter, a decision was made whether the NPV of the investment was good. So just before huge bucks are put in, you make an NPV decision. How do you make it? The only thing you evaluate about today is the money you're going to spend to start the project. Everything else comes from what will that create for you in the future, not in the past. Past is dead, right? The past is relevant to the extent that it helps you predict the future or it impacts the future, okay? Now, many years have passed and Google still exists. And I ask you, go value Google, what will you do? You want to look at what has happened in the past, how much money did they spend, how much money did they make. The value of Google stock, and remember it's not debt, so therefore the value of the stock, all stocks is the value of the firm. It's very simple conceptually. You look forward and you look at all the cash flows in the future and you get the discount rate from a comparable. Now that's a tough one. Who is Google's comparable? I'll let you go sort that one out. Because many times I can't even figure out what Google is up to. They're all over the place, right? So it's a very tough company to evaluate. So you look to the future, all cash flows, discounted now. You never look to the past. This is such an important principle that I have to tell you something about my life. I live finance, not on a spreadsheet, but in my value system. So when I'm driving, I'm driving, I never look at the rear view mirrors. And the reason is, I'm just looking forward, because that's where I'm headed. When do I look in the rear view mirrors? When somebody crazy behind me is changing lanes. You understand what I'm saying? Why? Because I know he may interfere with me in the future, right? A little bit later on. As a result of this behavior, I've had 7 accidents. But only 6 were other people's fault, only 1 was mine. Just a little joke out there to make you realize how literally I take life. But if you follow this principle, believe me, your mistakes won't be as many as mine. Okay. Value is created by real ideas and assets. And by the way, the word asset is just a word reflecting what your ideas become. So your ideas in your head, your assets are the personification of your ideas, right? So the idea was to create an iPhone. You had to get people, you had to get, yes, people are also assets. You had machinery, designers, software designers, creative people, all of the above to create. So those are your assets, but your idea has to come before your assets come. This point I think I've emphasized enough that I'm going to beat it to death. So let's keep moving on. This is key. So right now, more or less, I've focused on cash flows up to this point, that value is incremental, value is relative, value comes from future, value is created by new ideas or real ideas and assets. Now, when you think of cost of capital, remember, never think of return in isolation. I literally fall on my knees and beg you not to do that, because most of the world will force you to think about returns. Returns are percentages, they are screwed up. They really don't make any sense unless you think of risk. So to give you a simple example, when you open up any financial newspaper, you'll see the following. So-and-so fund has beaten the market so many times, or this security is better than S&P 500. That just doesn't make any sense. Yet we talk about it all the time. Why doesn't it make sense? Because you're comparing apples and oranges and only one dimension, which you like, return. We never talk about risk. Maybe it makes us feel queasy. There I go. A tongue twister that was. So the risk return always goes together. So if you are like me, living life without thinking too much about positive NPV projects, right? Hopefully I'm creating one through this education enterprise. But I'm not constantly thinking about positive NPV, do I make this investment or not? For me, I am buying stocks and bonds. If I remember the simple principle that risk and return go together, I'll never be confused. In a competitive market, I will just make sure that I figure out how much risk I want to take and then follow that strategy. A return should be higher the more risk I take, right? So just because I get a high return, I look at my colleagues and say, look, I beat you. What should the colleague say? Of course you beat me because you have a higher risk profile. If you think like this, you will not make a lot of mistakes. Think about another thing. If return was the only thing we looked at and we liked return, all our money would go to which kind of activity? One with the highest risk. Not true. If you look at people's financial asset holdings, and by the way, again I emphasize, only 10% of the world probably can make such investments. There's a whole profile. People's risk profile is very different, therefore return profile is very different. So there is no such thing as a good or bad risk-return profile. It's like saying you don't have a good name, right? I mean, that would be pretty bizarre if somebody walked up to me and said, you know, my name is better than yours. And I would say, okay, fine, mine is better than yours too. The same philosophy applied to risk and return. It just is. It comes in pairs. Of course, in a market that's not fully developed, you create opportunities, right? That's why I think, for example, even in competitive markets, insiders will make more money than the risk they take because they know more, right? So that's why insider trading should be looked at very carefully, because it's unfair to some extent, taking advantage of information that other people don't have. Otherwise, barring such opportunities, risk and return go together. Final takeaway, there is love, right? I started the class saying that I just love finance. But then, you know, love is super. Love is what all humans, believe me or not, are looking for. And contrary to what you may think or what I used to think, it's not being loved that we are looking for. It's opportunities to give and love others. That's what will make us happy in the end. So there is love, and what comes next? Finance. So please remember this main takeaway, that if you love, that's awesome, that's what you look for, but there's only one thing that follows it and will come along the way. If you get to know finance, love will become a little closer too. So let's take a break. I'll come back and talk about some other issues about the future. See you.